Welcome to our Taking Stock video for the week ending the 28th of June 2024. I'm Ken Trin, Head of Research at Stock Doctor, and today I'm joined by our Senior Portfolio Manager, Matthew Swartz, to share into you all things share market. How are you, Matt? Time certainly is flying, given that it's already near the end of financial year.
Yeah, I can't believe it, Ken, but it is great to be joining you for this last edition for the financial year of Taking Stock.
Yeah, likewise, Matt, and hopefully some of our investors will be using the portfolio manager just to get their tax issues in order. But before we get started, just a quick yet important reminder, the information we provide today is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile, so any past performance figures should be relied upon as a guide for future performance. Well, Matt, the Australian market, it was quite subdued this week after inflation data came in ahead of market expectations, with the core annual CPI running at 4.4% in May, up from 4.1% a month earlier. And this is well above the RBA's inflation target of between 2 to 3%. And the news has certainly lifted bets that the RBA could increase interest rates in August. So bond traders, they're now pricing in a 41% chance that the RBA will raise the cash rate to 4.6% by September this year. And this is up from 13% before the news. So you can see this with the chart on screen, which shows the implied rate jumping significantly higher over the week.
Yeah, there has been a couple of wobbles on market, Ken, but in the end, it was somewhat subdued and some money sort of poured into equity markets yesterday and is likely to today as well. But from a household perspective, it is a massive blow to those that were expecting some form of financial relief this year. And now they're potentially facing additional stress in their mortgage interest payments. Let's remember, though, that households will be getting some tax cuts next week, which will provide some form of a counterbalance. But ultimately, the picture for forecasted earnings growth over the next 12 months becomes far more challenging if we remain within this restrictive monetary policy or if it gets more restrictive. And as a fundamentals first investor, we have remained concerned that markets have been far too complacent on the risk of earnings disappointment this year and next. And this week's development only reinforces our view that this is a time to be careful, that this is a time to be selective about how we position our portfolios. That said, the US equity market indices like the S&P 500 continues to present a picture of total positivity. But if we do look beneath the bonnet somewhat, much of the price rises this year have been heavily concentrated in a handful of mega cap tech stocks like Nvidia, Meta, Tesla, Apple, Amazon, Alphabet, and Microsoft. At the moment, the fear of missing out on the artificial intelligence theme is fueling the broad market prices, but there are parallels being observed here that are very reminiscent of the tech wreck of 2000. As bottom-up investors, it's now more important than ever that we review our portfolios, take profits where prices have run ahead of fundamentals, and take control as we head into a period that we believe will be quite interesting from an earnings and reporting perspective in the period ahead.
Yes, Matt, the disparity between US and Australian share market performance remains quite stark. And you touched on this topic about mortgage payments, household budgets, and consumer spending. And locally, the consumer discretionary segment continues to struggle, especially those that are in financially weak position. Take, for example, you've got Star Entertainment Group, currently in marginal financial health due mainly from poor cash flow issues. The business faces challenging regulatory and trading conditions, and the uncertainty around the remediation and also transformation costs there as well. Not surprisingly, Star Entertainment, they released a financial year 24 profit update, which was 10% below market expectations.
Yeah, it's one of those stocks that we were warning investors like last week in a webinar. You, me, and Tim were actually highlighted Star Entertainment Group as one of those stocks that you don't really want to touch as the outlook continues to remain so uncertain. And although on a traditional valuation measure, it may seem somewhat cheap, its poor financial health alongside this management uncertainty, we're regarding this one as a value trap. Also, within the consumer segment over the week, we saw an eye-watering 50% decline in the share price of online luxury retailer Cettire. And the move was based around an earnings miss to expectations. But if you have tuned into any of our Lincoln Live sessions over the last 12 months, our members would certainly have avoided this one, as there's been a number of red flags that we have highlighted after going through our 9 golden rules.
Yes, this certainly was a stock that was pretty hot among a lot of fund managers, Matt, and these risks that we've clearly articulated in the strategic comment, including, there was a significant share sale from CEO Dean Mintz, its low profit margins, and also uncertainty around how it avoids import duties as well. No doubt, short interest on the stock has continued to rise, and even though the stock is trading at a large discount to fair value, we would prefer to remain on the sidelines with this stock for now. The earnings outlook and valuation will also likely be updated to reflect the earnings downgrade over the next few days.
But not all consumer-driven businesses performed all that badly this week. We also noticed an announcement from Baby Bunting, which reaffirmed its earnings guidance, and this led to a strong positive price reaction for the stock. However, we do remind investors to be very careful here because the initial guidance was already very low. And with the market anticipating earnings to decline by about 70% for this year, and ROE expected to be in the 3 to 4% bracket, we see much better opportunities elsewhere in this space.
Yeah, so just be careful with that one. But another retail stock that performed well during the week was Premier Investments, which offloaded or plans to offload its apparel brands division, including Just Jeans, Portman, Jackie E and Dotti, to Myer. So collectively, these brands make up around 50% of Premier's total sales. And if the acquisition proceeds, Premier shareholders will receive shares in Myer, leaving just the Smiggle and Peter Alexander brands within the Premier Investments Group.
It was a bit surprising because both Myer and Premier shares rallied quite hard on the back of the potential synergies, I guess, of about 55 million a year within Myer, although we do note that significant dilution to Myer shareholders awaits. However, this will improve its profit margins currently, which is sitting at only 2%. And in addition to this, retail mogul Solomon Lew will have a majority stake in the Myer business, providing his influence and strategic direction. And investors were also optimistic that Premier may spin out its other brands like Smiggle and Peter Alexander.
Yeah, there's going to be a lot of restructuring going on, and we'll have to sit on the sidelines for now here just to see how this deal will impact the outlook for Premier Investments at the moment. But next week, a key data point will be the May retail sales report, expected to be released around the 3rd of July. And this will help provide more color around those consumer spending and retailers, especially across our star stocks, Wesfarmers, Super Retail Group, and Star Income Stock GUD Holdings.
And moving across to the healthcare space, a potential opportunity emerged again for sleep apnea product manufacturer and star growth stock ResMed. The stock was sold down significantly during the week after Eli Lilly, which is producing a weight loss drug at the moment, announced that its drug reduced sleep apnea events in people suffering from obesity. And this has raised some concerns about the potential market impact for ResMed, whether its strong growth forecasts and ROE are effectively achievable. Some analysts suggest that the impact on the weight loss drug could reduce ResMed's total addressable market for continuous positive airway pressure, otherwise known as the CPAP, machines of about 15% over 3 years to financial year 28.
Yeah, certainly a bit of volatility there, Matt, and we've been here before, and our team believes that these events can lead to opportunities for investors who believe in the fundamental quality of the business over the long term. Remember, ResMed did note that many patients who took the weight loss drugs still needed the CPAP machine to function, but we'll be closely monitoring the situation and also its earnings revisions in coming months. In Under the Microscope this week, we take a look at Exstar Stock, an operator of KFC and Taco Bell brands across Australia and Europe, Collins Foods. What has really sparked our interest in this stock is the release of its financial year 24 result, which led to a share price rally, only to have its gains evaporated the day after. So what happened here, Matt?
Yeah, very much a roller coaster, wasn't it, Ken? Look, I think the market optimism was driven by very small beats to consensus estimates, with a 10.5% rise in revenue, and operating cash flow was also very positive, up 21%. And in addition to that, the business increased its final dividend to 15.5 cents, which compared to 15 cents a year ago. Net debt was also significantly down, providing real support here for its financial health. But the following day, as analysts and investors digested the news, there were parts of the report which did dampen enthusiasm. Cost pressures from the inflationary environment and intense competition in fast food space continues to put pressure on the net profit margins, which are sitting at about 4%, which is below our thresholds. And meanwhile, like-for-like sales growth slowed in the second half across all divisions, and tough conditions have continued into FY25 when they provided their trading update.
Yeah, some concerning issues there, Matt. But I noticed that the stock has experienced negative earnings revisions over the last 3 months as well. Will this subside following the result, though?
Look, the group has faced earnings downgrades from analysts on the back of these higher inflation pressures and wages and weak consumer spending. However, following these results, some analysts are anticipating a recovery in the second half of 2025 from tax cuts, cost savings, and the rollout of new KFC restaurants.
Yeah, Collins Foods, they have had quite a rocky past couple of months following the departure of their managing director and also CEO Drew O'Malley after his wife underwent serious illness. In the interim, though, you had the business currently run by Mr. Perkins, who holds about 65 million or 6% of stock. And Mr. Perkins was CEO of the business for around 29 years up until 2019. But a question that a few investors have been asking is whether the recent bird flu outbreak has impacted the business.
Yeah, the initial concern around this did lead to some volatility on the stock when the news broke in late May. However, management stated bird flu affected egg-laying chickens rather than those used for consumption, hence why there's been a shortage of eggs in that market.
Yeah, thanks, Matt. Although some investors may view the share price discount as an opportunity, we would prefer to sit on the sidelines for now with this stock until we see evidence of a recovery in the business profitability, namely its return on equity, its earnings revisions, net interest margins. So look out for that. And following on from a hotter than expected inflation print this week, an interesting question is which star stocks tend to do well in an inflationary environment?
So the chart on screen shows the correlation between rolling 12-month returns and rising inflation. In general, the sectors that perform best in rising inflationary environments are energy and gold. Higher oil prices tend to lead to higher inflation, hence energy stocks tend to do quite well. Similarly, the demand for gold rises because precious metals is regarded as an inflation hedge, all else being equal. Among the star stocks that perform well in this higher inflation environment within energy, we have exposure to Karoon and Woodside Energy, and our star growth stock exposures here include Alkane Resources, Capricorn Metals, Gold Road, and Perseus Mining.
Yeah, quite a few resources stocks there, Matt. And if you refer to the chart, you'll notice that REITs or property trusts also tend to perform well as well, because investors, they move to property for protection against inflation. And within REITs, our star income stocks include Arena REIT, Charter Hall Social Infrastructure, BWP Trust, and also Waypoint.
And prices for consumer staples such as food and utility bills tend to align with inflation, hence why this segment also tends to perform relatively well. Within consumer staples, our star stocks include Coles, Woolworths, and even Treasury Wines and Endeavour Group. Meanwhile, within utilities, there is star income stock APA Group.
And referring back to that chart, on the other end of the spectrum, sectors that tend to perform poorly during higher inflationary environments include consumer discretionary, that's retailers, technology, and also financials. And this isn't a surprise, given that stocks within these sectors are more sensitive to higher interest rates, which tend to occur in tandem to higher inflation.
Yeah, let's throw a caveat in here though, Ken. Although the theme is interesting and can be rewarding if you get the inflation trade right, I haven't seen too many forecasters actually get the inflation numbers all that accurately. So we do prefer to avoid making decisions on macroeconomic events and rather invest in businesses based on their fundamental quality. We obviously look for financial health, past performance metrics, and do active risk assessments. And this has proven to be historically valuable over the long term.
Yeah, definitely stick to the fundamentals, what you can research and understand. But that's all we have time for today. And thanks for your insights, Matt.
No, it's been my pleasure, Keen. And if you have any questions with today's episodes, feel free to participate in our Lincoln Live webinar on this coming Monday.
And with the end of financial year, remember to review your portfolio under the Portfolio Manager, where you can also produce those reports for tax time. And also, it may be a good time to introduce Stock Doctor to your family and friends. They can take advantage of our current promotion. You only have this weekend left, so you can either do this by refer a friend tab or send them a link to the free trial page. Have a happy, healthy, and prosperous week ahead.